Is the stock market in a bubble or not? Depends on the data. You came here for the truth, so let me unveil that for you. You can ask somebody about Nvidia stock or maybe some other high-flying stock and ask them the question, is it a bubble? And some would say yes, and some would say no. You ultimately will decide and put your money where your mouth is. The best advice that anybody can give you is that you got to do your own homework and that you shouldn't be watching the YouTubers of the world to ask which stocks should I buy. You need to be able to determine what is a good pick and what isn't. And you also need to determine your exit before you make that purchase. This was taught to me, and I hope that you will get that as well. Don't ever rely on somebody else to tell you what's good or not. I've been screaming about, for instance, uranium, but I'm not telling people to buy uranium. I've been talking about this since 2020, many times, repeatedly since 2020. Uranium. Look at chemical. Look at the physical sprout uranium. Look at it. Over and over again. But I wasn't telling people as like, you better go buy this right now. It's like, hey, check this stuff out. And now what's happened? The prices have multiplied. Okay. Why? Because I'm able to see the trend there. I know what's going on. I understand the dynamics. Doesn't take a genius to figure that out. But I hope people would get that info and then start digging in. That's all I'm saying. Whereas others, I remember one individual, I tuned in. I'm like, what's this guy saying right here? And the video was, somebody asked him, what do you think, what's your stock prediction for Tesla? And he said, 1250 for Tesla? Oh, absolutely. And it was like 1250 for Tesla by April? Oh, yeah, absolutely. Oh, yeah, no problem. I mean, giving actual price predictions and date predictions. And was there backlash? Absolutely not. Absolutely not. But anyway, whatever. The more I found, the more that you flip-flop and the less productive information you give, then the more popular you can be in this niche. I'm talking about in the niche. I'm not talking about Mr. Beast or whatever nonsense. Numbers of mentions of generative AI-related topics in corporate transcripts of the Russell 3000. Are we past the peak hype? Already they're kind of, going away, dying off. That's not making its way in there anymore. I think a lot of it is kind of just, all right, I see what's going on here, and, wake me up when this is going to make my dinner, basically. Nvidia from 2020 to present day compared with Cisco back in the tech bubble. Some are comparing it to that. It's a different circumstance, there's no question. You're never going to find a perfect parallel ever. But I want to know if you think it will end up in the same way. In the case of SMCI, my goodness, that came down painfully. The question is, where does it end? Is it simply a dip and then it resurges even higher? Similarly, in 2000 and 2008, a large percentage of consumers hit their credit limits and consumer spending dropped dramatically. This cannot end well. This is basically a threat, suggesting that what we saw before will in fact happen again. There are many different indicators which have gone off the charts. And in fact, I'll show you some of those right here. You're looking at Goldman Sachs has these. I've seen Bank of America have these. Morgan Stanley, basically all the different banks through all the different years that I've seen these. They all have their own different reports. Okay, when they publish these reports, you get these charts giving you updates. Okay, either they're weekly reports, monthly reports, and in this case here, we're just looking at the current positioning. Yeah, are people overinvested, underinvested? In this case here, we've gone into the level of stretched positioning. When we get to these levels, at some point in the near future, the likelihood of dropping in stocks becomes higher. That's all that means. Same thing as like extreme bear, extreme bull. Where are we right now? We are moving towards that territory of like too much bullishness. This is also apparent with many different indicators that will, traditional indicators that you would look at, could be your RSIs, your stock RSIs, stochastic slows, these type of things, okay? Looking at this, which is, okay, what the chart is trying to show, and I believe the next chart as well, is Eli Lilly, which has gone, I mean, we talk about the Magnificent Seven all the time, but a pharma company just going absolutely wild. It's become the next, NVIDIA, outperforming it in the last, like just those last several days there. My goodness. And then we have this. Just see that. I mean, measured in different ways, you're going to see how incredible this stock, Eli Lilly, has performed and where the expectation will be in the next little while. Their earnings, of course, should be a big factor in that. But somehow earnings and profits and all these things are less important today. Like when companies lay people off because of hard times, what did Meta do in order to bring back confidence? They laid a whole bunch of people off, okay, like crazy. Although they did hire going up into that. But the point is they laid a whole bunch of people off and they stopped talking about metaverse and started talking about AI. That's right. Magnificent Seven's optically favorable risk profile. All right, just showing you the risk-adjusted returns. They're saying that this is the way to go. Got to get on that Magnificent Seven because the downside risk is low. That's arguable. That's debatable because what goes up must come down, they say, unless this time is different. Worst equity market breadth since March of 2009. So Sparky, if you're watching this right now, we're talking about this from the Finance Friday. Check this out, okay? So I pulled this chart up, Bank of America. You'll see these here. And when I see these type of things, there's measured in different ways, breadth. But this is just showing us S&P 500 versus the S&P 500 equal weight. And you could see it's gone into this crazy territory. Why? Because a few stocks are pulling the whole market up. And usually that ends badly. That's all that means. Doesn't mean it's going to end badly. But usually it ends badly. So, take what you want from that. Inflows to tech on course for $85 billion in 2024. Looking at tech fund flows, seeing that there's a lot of money going in there, excessive cash for what we see, like the amount of money that's moving in there. This is, by the way, you can see at the bottom, EPFR, all right? The EPFR tabulates all of the money flows from one place to another. And we know specifically that there is an infinite amount of cash going in, and it is blowing a big bubble, not just in tech in general, but in a few names. You could see the short history of bubbles, comparing all of them. You go back, South Sea Company, right? I've read about these many times before. And you see these coming up, and they have some similarities. It's usually what I love to see within them is the euphoria. And it seems as though nothing could change. Oh, this is it. Everyone loves tulips. Tulips are the next big thing. But then something changes, right? I went to the tulip markets in Amsterdam and saw this for myself. Just interesting to see having that piece of history right in front of you like that. I mean, it's pretty wild. Now they're not exactly worth millions of dollars anymore. Still valuable, sure. They have value to them, but not like we were seeing at that time. So anyway, you could see here on these charts, just showing you a comparison of where we are at in comparison to previous bubbles. Just remember the sentiment. That's all. That things get really crazy before they get normal again. The Magnificent Seven trades at PE ratios of 30 times versus 18 times for the S&P 493. So again, Sparky, this is what we're talking about here. Like when you extract those few names, what do you get? And you get a much more normal circumstance. What is the historical PE ratio? Somewhere between 16 and 17. All right. In recent years, that number has been higher, right? And also tech tends to have higher PEs. So when we put that in there, let's just say 18, it's relatively normal. You start extracting just those Mag 7 stocks and it's crazy. Pretty crazy anyway, averaged out. It's not normal to have them be so high. But people can argue about that if they'd like. Solid momentum. U.S. firms have announced repurchases totaling $155 billion so far this year. We're talking about stock buybacks. Stock buybacks are the number one buyer of stocks. Do you get it? Apple is the number one buyer of Apple stock. Walmart is the number one buyer of Walmart. Like whatever. They're just the biggest buyers in general. Generalizing, of course. And if they keep doing that, it could push the stock prices up. Tech bubbles popped by rates, penetration, and or regulation. So they're just comparing, going back, all the different bubbles measured in this different way. AI is the new thing. Regulation, no question about it, is a very significant factor to determine the future of the prices of these AI stocks. We have basically no regulation right now. And if they put something in place that can kind of hamper its growth, that will affect its price, at least, that turbulence initially. So keep an eye out for that, all right? If you want to know more about the Finance Friday, where we get into depth for 2 hours every Friday, check out the link in the description, themoneygps.com/live. I want to see you on there where I can get into the things I just can't get to here on the channel, all right? And as always, don't forget to hit that thumbs up button on your way out, and I'll see you tomorrow. Take care.